Thank you for joining me. I'm Juan, lead trader and founder of Prosperity Trade. In this video, I'm going to continue the series of reading a financial statement. We started off with the balance sheet, and you can click on that video with the link above if you haven't watched that one yet. Today, we're going to get into the income statement, and it's just going to be a basic introduction to give you an idea of how to read an income statement. You're going to want to watch this video. So today we're going to be discussing the income statement. And the income statement is extremely important. It tells us a lot about how much the company is making after cost. So let's go over the definition of an income statement. So, what is an income statement? An income statement is a financial statement that shows you the company's income and expenditures. It also shows you whether a company is making profit or loss for a given period. The income statement, along with balance sheet and cash flow statement, helps you understand the financial health of your business. And we went over the balance sheet. The income statement is also known as profit and loss statement, statement of operation, statement of financial result or income, or earnings statement. So let's look at an example of a real life income statement. This is Apple's income statement. If we look here on the top, they have their net sales. These are the products and services that they sold. And this is how much money they made strictly from the products and services that they sold. So this is in millions. So it'd be 1 million, 10 million, 100 million, 1 billion, 10 billion, 260 billion. So we can't just go off of this number because we need to know how much money did they have to spend to make this number, to make this revenue. So here, the first line is basically the direct cost that it cost them to make this. So for products, the phone itself, the metal, the design, and all the stuff that all everything that came into making the actual phone, this is the direct sale and the direct service, whatever was the direct service, eh, whatever it cost them to get this money directly. So after they subtract these two, they have the total cost, or they add these two, the products and services is 161 billion. They subtract that, and they're left with a gross margin of 98 billion dollars. So gross margin is total net sales minus cost of sales, and that gives you the gross margin. Then this is the indirect. So there was research and development and sales, general, and admin fees. So it's indirect because the research wasn't directly connected to actually building the phone, but there was research, whatever indirect cost that's here in operating expenses. And there was over 34 billion in indirect operating expenses. So their operating income is gross margin minus total operating expenses, and that gives you the operating income. Then we have to factor in taxes that they paid. And after you factor those things in, you get the net income. This is the money that they take home. So let's break that down. So, income statement format, what does it consist of? As we mentioned before, we have the revenue. And when you subtract the direct operating costs of the revenue, that gives you the gross profit. Now, when you take those gross profits and you subtract the indirect operating costs, that gives you the operating income. And when you take the operating income and you subtract the cost of debt finance minus the tax, it gives you the net income. This is what they take home. So let's start to build a income statement, and we'll start here. So this is the format. It starts with the direct cost to sell the product. So we have the revenue and whatever it directly cost to make that revenue. So for this example, I just chose any device, let's say some sort of light or some sort of computer or some sort of whatever device. We sold $3 million worth of that device, whatever product that is. But in order to make these devices, it cost us $1 million to make these devices. So we sold $1 million worth of devices that it took us to make and made 3 million. So now we subtract the 3 million of revenue that we made minus the cost, and now we have our gross profit of $2 million. So let's go a step further now and factor in the indirect cost, the indirect operating cost. So we have here our initial one, our gross profit of 2 million that we initially had. And now we're saying that marketing cost us 400,000 and sales, general and admin cost us 600,000. Gives us a total of $1 million total cost. So it's a million because this is 400 plus 600 is a million. We're subtracting that from the gross profit. So $1 million after these indirect costs here. So this is also called EBIT, earnings before interest and taxes. So this number is important and it's also useful because now we can start getting some ratios that gives us an idea of how the company is doing compared to the sector that it's in. So what we're saying, in order to make this $1 million, we're trying to look at the assets that we spent, the machines, whatever equipment, whatever assets we spent to make this business generate this revenue or make these cost of good. We'll just say that all our assets cost us $10 million. So the formula is net income, our operating income, the $1 million, divided by our total assets. So it comes out to 10%. Now we can compare that to the sector, and it tells us that for every for all our assets, we're getting a 10% return on assets. So, and what is a return on asset? Return on asset, you're able to compare the value of a business asset with the profits that it produces over a set period of time. It's a pretty important tool used. It's usually used by managers and financial analysts to determine how effectively a company is using its resources to make profit. It's good to compare this to whatever sector you're comparing it to. Okay, so now we had our operating income. Let's add, we had our operating income here of $1 million. And assuming we took out a loan, whatever the loan was, let's say the interest payment was $100,000. So we have our $100,000 for whatever loan. If we took a loan out, this is our interest payment. We're subtracting that from the operating income, and now it gives us a pre-tax income of $900,000. So this is not 100% take home yet because we have to pay taxes. So let's just assume there's a 25% tax. We pay the 25% tax, which is 225,000. And our net income, our take home, what goes to the bosses, the owners, is $675,000. And this price here, now we can get another ratio and we can learn return on equity, which is another good ratio if you're trying to compare companies in the same sector and trying to find a stock that's possibly undervalued. This will be one of the many tools that you can use along with other tools like finding intrinsic value, looking at PE ratios, comparing it to the other sectors, comparing other ratios just to see if you're getting a good deal, if it's undervalued compared to its competitors. So let's kind of break down how we get return on equity. So, return on equity, the formula is the net income, which is after everything is paid, 675,000. Then the shareholders' equity. So, what's that? So we said earlier today, we said that the assets equal $10 million. We have $1 million in debt. So we subtract the debt from the asset, and the equity is $9 million. This is the shareholders' equity. So we'll divide that, and it gives us 13.3%. So what does that tell us? What is return on equity? It's basically a financial performance metric that is calculated by dividing the company's net income by shareholders' equity. It tells you how effectively a company is using its net assets to produce profits. So, obviously, the higher the return of equity, the more effective the company is producing profits. But of course, you have to compare this to its sector. And this was just a very simplistic, basic introduction to an income statement. Some of these factors are going to change depending on what kind of income statement you're reading. If you're reading an income statement for a bank, for example, you'll see some different things, and just different companies, different sectors are going to have kind of just different items that are going to affect the income statement. But this is just an overall basic understanding. What I wanted you to understand was the operating income, the net income, a couple of these ratios that are useful for you. That was the goal of this video. I really do hope you enjoyed the video. The next one would be cash flow statement, and that would be the conclusion of basic introduction on how to read a financial statement. I hope at the end you have a basic foundation, a basic understanding of how to read a financial statement. And I hope you enjoyed the video. Thank you for watching. See you on the next video. Please don't forget to subscribe, comment, and like. And thanks for watching.